Probably RBI will reassure markets that we'll see through this inflation number, but we'll keep a hawkish watch on inflation and we will be data dependent. I think RBI has reached peak of raising interest rates in this cycle, but the rate cut cycle will begin only after US Fed starts cutting interest rates. So there is no one standard definition for investors. There is a different mix of investors, from young India willing to take risks to HNI India, which is trying to protect their capital. And they are all choosing their investment vehicles very, very smartly. One point I would like to highlight is the tremendous maturity of retail investors. In the past, whenever market used to correct, the flows used to slow down. Now it is exactly opposite. In a rising market, it is SIP minus redemption and net flows come down. In a falling market, it is SIP plus subscription and we get more money to buy into a falling market. I think this maturity of investors is truly protecting the bottom of the market. So we have seen that market is not necessarily the best predictor of election outcome.
Right.
Analysts and surveys going wrong on election, market also misses jungle for the wood. In 2004 as well as 2009, we have seen market completely missing the election outcome. At this point of time, market is discounting the continuity of government policies and continuity of government. They'll continue to observe data on the field. If there is any deviation to what is discounted by the market, then there could be correction. But it will be fair to say that market has a keen watch on election outcome. And at this point of time, market is discounting there will be continuity of government and government policies. Second, for us, IT sector continues to be major revenue earner. And today there are some dark clouds on IT sector in terms of growth. Energy prices is important for us, not only from price point of view, but also availability point of view. The geopolitical scenario, which is changing so rapidly, will have to ensure that energy is available to us at cheaper prices and it is available as much as we want. Finally, there is Fed pivot. If you are going to get, higher interest rates in US dollar treasury, to that extent, your expectation of return from emerging market equity, including India, will be higher. And that could result into de-rating of our valuation as we trade at premium to others. So there will be many global factors which will continue to impact market, and which is why our first advice, please keep some dry powder at this valuation of the market. It's a fair value market or little above fair value, and hence having neutral allocation to equity with some cash to buy during correction will be appropriate. So as of today, there are two sectors which are little bit below its fair value. And I wouldn't call it significant discount, but undoubtedly little bit below. One is pharma, other is IT. In IT, as I mentioned before, there are uncertainties in the short term about demand growth. We believe the second half IT spending will be stronger than first half, and hence to some extent this will be mitigated. The bigger worry is related to machine learning and artificial intelligence. Will there be elimination of basic programmer because of advancement in artificial intelligence? We believe companies which will ride the curve of artificial intelligence will become more efficient, will deliver better solutions, and hence investing with them over a medium term will be profitable. So IT is one sector where one can start making investments. It's going to be uncertain for a while, but then you have to catch the falling knife. When certainty is there, prices would have moved up. The same thing is with pharma. Valuations have corrected. The catalyst for pharma sector will be related to generic product approvals and expansion in margin. over a period of time. Unlike IT, where broadly industry moves in similar direction, in pharma, companies can have completely individual behavior. So build a portfolio of pharma and IT stocks over a period of time. They look undervalued relative to their historical valuation in relationship with the market today. So undoubtedly, market expectations are lower, and any catalyst on those expectations will result into re-rating of the sector. One important thing is that today 45% of medicines consumed by Americans by volume is made in India, and yet it costs just 10% of American pocket. Clearly, we are the cheapest medicine provider to American ecosystem. At some point of time, there will be equilibrium between distributor and manufacturer of medicine. Today, there is oligopoly in US distribution system. And unless until margins move from distribution to manufacturers to some extent, this scenario is unlikely to continue. We have already seen some Indian companies not launching a product if the margin is not sufficient. My feeling is that one, there will be equilibrium between distributor and manufacturer from a margin point of view in the days to come. The second will be again adoption of Indian medicines across the world. There are many companies which are now moving into branded launch. This also will aid to the margin. The third and the final thing is India story per se. As we move from $2,500 to $2,000 per capita GDP, from spending on roti, kapda, makan, will be now focusing more on education, entertainment, travel, tourism, and medicine. Put together all these things together, I think there is bright days ahead for Indian pharma sector.